Welcome back to the Working Thesis Market Daily. This is the updated Tuesday, June 16th episode, now incorporating the per-thesis market news sweep. I'm Nova.
And I'm Onyx. Same editorial rules. This is selective evidence around the thesis framework, not a set of instructions. No personal trade content, no stock recommendations, and individual company items stay factual.
Quick housekeeping. This is personal market commentary, not investment advice, not a recommendation, and not a forecast. The thesis reads are probabilistic and meant to stay open to revision.
Which is useful because markets already have enough confident people shouting through a fog machine.
The one-line read today: Semiconductors bled for a second session, but the broader market did not break in the same way. Money rotated into financials, industrials, utilities, and gold miners. It looked like a tech blood donor session.
The index split tells the story. SPY closed down 0.6%. QQQ fell 1.9%. IWM small caps fell 0.87%. But the Dow ETF DIA rose 0.58%.
Volatility did not panic. VIX finished at 16.41, only up about 1.3%. The 10-year yield eased to 4.43%, and the dollar index was basically flat.
So this was not clean risk-off. It was more like a crowded pocket getting drained, while other parts of the market still had a bid. The open question is whether that was a real second quarter to third quarter rotation, or mostly positioning noise before the Fed and quad witching.
The sector map was blunt. Semiconductor ETFs were the main damage. SWXX down 5.9% and SMH down 4.8%. XLK, the broad tech ETF, fell 2.79%.
The destinations were almost the mirror image. Financials rose 1.47%. Industrials gained 0.65%. Utilities added 0.72%. Gold miners through GDX gained 2.31%.
That rotation is important because 9 of 11 sectors were green even as the broad index dipped. When breadth improves while the index falls, it usually means the market is not uniformly weak. It means the big weights are doing most of the dragging.
Or, in today's less elegant wording, tech stopped being the bloodsucker and became the blood donor. The money did not leave the building. Some of it just changed chairs.
The caution is timing. Quad witching can exaggerate flows, and tomorrow's Fed event can reset the whole read. So this is a rotation signal, but not yet a rotation verdict. Thesis 1, AI as the available productivity story, had a complicated day. The semiconductor tape was ugly, but the news flow still supported the idea that AI infrastructure and AI applications are becoming strategic assets.
The semiconductor sell-off looked more like valuation and positioning stress than a clean demand break. The SOX index fell 5.9%, and a large share of the group's year-to-date gain had come from multiple expansion, not earnings revisions.
Said carefully, a pullback after multiple expansion is not automatically evidence that AI demand is broken. It can simply mean the market was priced for perfection and then started charging rent for perfection.
The fresh application side story was SpaceX's reported all-stock acquisition of Anysphere, the company behind Cursor, for about $60 billion. Reports describe it as the largest venture-backed startup acquisition on record, expected to close in the third quarter pending approvals.
The individual company fact is the deal. The thesis read is broader. AI coding remains one of the clearest commercial AI use cases. If a major platform is willing to pay that kind of strategic price for a developer tool, it reinforces the idea that AI is moving from demo to workflow.
Nvidia added another infrastructure clue. It reportedly raised $25 billion in bonds, with about $85 billion of orders. Nvidia also announced XRAI, expanded its HPE AI Factory partnership, and continued to highlight Blackwell performance in MLPerf results.
That is not a stock call. It is an infrastructure read. The AI build-out is increasingly funded like infrastructure. Debt markets, data centers, chips, networking, software tooling, and power contracts all tied together. Thesis 2, Incumbents Adapt, also had a mixed but useful day. The Oracle-Microsoft report is the cleanest reminder that enterprise AI is not just about model quality.
Business Insider reported that Microsoft walked away from a more than $3 billion Oracle Cloud Capacity deal because Oracle's public cloud lacked FedRAMP authorization for the workloads involved. Oracle disputed details of the report, and Microsoft did not comment.
The individual stock facts stop there. The broader read is that compliance, certification, government workloads, customer trust, and integration can all shape AI infrastructure winners. Boring enterprise plumbing can still move very large budgets.
Salesforce added a different kind of evidence. Its summer 2026 release moved Agentforce multi-agent orchestration into general availability, with tighter Slack and Tableau workflows. The stock remains weak, but the product cadence shows incumbent platforms are still shipping AI into existing workflows.
ServiceNow's AI Control Tower is another enterprise plumbing example. Reports describe it as a governance, observability, security, and measurement layer for AI agents across multiple systems. That matters because as companies deploy more agents, controlling those agents becomes part of the software stack.
So Thesis 2 is not cleanly supported or rejected today. Software stocks lagged, but incumbents are still adding AI features and governance layers. The market is debating whether that AI becomes margin expansion, cannibalization, or just required spending to defend the base.
Thesis 3, the sovereign debt pressure valve thesis, stayed intact. Gold futures closed around $4,340, up 0.23%. GDX miners gained 2.31%, outperforming spot gold for a second day.
The important detail is that gold held near record territory, even with the dollar basically flat. That fits the framework better than a simple crisis headline story. Gold is being treated as a debt, debasement, reserve diversification, real yield, and dollar stress instrument.
In the Iran sequence, de-escalation has helped crude fall and may reduce the immediate inflation impulse. But the refined gold mechanism remains case by case. When the dollar spikes in a crisis, gold can be pressured by forced selling. When dollar stress eases, structural buyers can matter again.
Tomorrow's Fed event is the real test for this thesis, because a Fed credibility or real yield dollar move is different from a geopolitical safe haven dollar move. A stronger dollar from hawkish policy would be a cleaner stress test for gold than the Iran headlines were.
Again, this is not a prediction. It is a map of which driver matters. If gold keeps holding while DXY is stable or soft, the structural buyer story looks better. If real yields and the dollar jump on policy credibility, the thesis gets a harder test. Thesis 4, energy as the binding constraint, probably got the most concrete confirming news outside the headline semiconductor sell-off. Utilities were green, copper was positive, and the nuclear power complex stayed in focus.
Cameco and Orano agreed to acquire TEPCO's 5% interest in the Cigar Lake joint venture. Cameco's ownership rises to about 57.4%, and its share of the purchase is reported around $115.75 million, pending regulatory approval.
Cameco also resumed full production at McArthur River and Key Lake after flooding-related disruptions, with production guidance reportedly unchanged. The individual company fact is operational. The thesis read is that control of high-quality uranium supply matters, more as nuclear demand comes back into the AI power conversation.
Constellation remains the biggest public example. The 3 Mile Island Unit 1 restart, tied to Microsoft's long-term power purchase agreement, shows how hyperscalers are reaching for always-on, carbon-free baseload power. That is the physical shadow of the AI story.
The broader power basket also matters. Vistra and GE Vernova are often grouped with Constellation as AI power beneficiaries, and GE Vernova's small modular reactor work keeps showing up in the grid and nuclear conversation.
The takeaway is simple but not simplistic. AI may be software at the user interface, but at scale it becomes power, permitting, turbines, uranium, copper, transformers, and interconnection queues. The cloud still needs a plug.
Thesis 5, pragmatic multipolarity, had no major U.S.-listed China company catalyst today, but the market split itself was useful evidence.
China's CSI 300 rose 2.35%, while Hong Kong's Hang Seng fell 0.37%. That divergence matters because China-related markets do not move as one object.
A-shares can trade on domestic policy, domestic liquidity, and local investor behavior. Hong Kong and U.S.-listed China exposure can trade on global risk appetite, currency, regulation, and listing venue discount. Same country, different tape.
That fits the pragmatic multipolarity frame. The world is not cleanly decoupling, but capital channels, manufacturing strength, technology controls, and investor access are fragmenting. The China story is not simply bullish or bearish, it is segmented.
The AI model export control story also belongs here. Reports say the U.S. Commerce Department restricted foreign access to Anthropic's most advanced models under export control logic. If that path holds, it is a shift from restricting only chips toward restricting model access itself.
That could push more countries towards sovereign AI and local data center capacity, supporting AI infrastructure and power demand. It also adds policy path risk for the model companies and for global enterprise adoption. Important, but still early.
One cross-cutting thread from the sweep is equity supply. SpaceX reportedly used stock as acquisition currency for Anysphere after its IPO. At the same time, major AI companies and infrastructure players are increasingly using debt and public market financing.
That matters because the AI boom is not just demand. It is also financing. If more private AI leaders come public, and if big companies issue stock or bonds to fund AI build-out, the market has to absorb new supply.
This is not automatically bearish. Productive capital formation is how infrastructure cycles get built. But it can become a headwind if issuance rises faster than buybacks or free cash flow.
So the cross-cutting question is, does AI financing remain a sign of confidence, or does it become a valuation pressure point? Today's Nvidia bond demand points to confidence. The semiconductor sell-off points to valuation sensitivity. Both can be true.
Thesis 1, AI necessity, mixed but still supported. Semis sold off hard, but the Cursor deal, Nvidia bond demand, AI factory news, and Capex channel all support the idea that AI infrastructure and AI coding remain strategically important.
Thesis 2, incumbents adapt, mixed. Oracle's reported FedRAMP issue is a small negative for the enterprise infrastructure story, while Salesforce and ServiceNow show incumbents still shipping agentic workflows and governance layers. The market has not decided whether that creates durable value.
Thesis 3, sovereign debt and gold, intact. Gold held near highs, miners outperformed and yields eased. The next real test is a policy-driven dollar and real yield move, not just geopolitics.
Thesis 4, energy constraint, supported. Utilities, uranium, nuclear restarts, hyperscaler power deals, and copper all continue to point to the same physical bottleneck under the AI story.
Thesis 5, pragmatic multipolarity, neutral to modestly reinforced. China A shares diverged from Hong Kong, and AI model export controls show fragmentation moving from chips toward models. But this remains a slow-moving thesis, not a one-day verdict.
The next catalyst is the federal. The decision itself may be less important than Chair Warsh's language, the dot plot, forward guidance, and any comments on quantitative tightening. A hawkish tone could keep pressure on high multiple tech. A softer tone could help risk appetite broaden again. A neutral tone could leave today's rotation unresolved.
Then comes quad witching, which can make price action look more meaningful than it really is, followed by the expected Iran signing window on Friday. So the cleanest framing is not prediction. It is evidence tracking.
After the per-thesis sweep, the question is sharper. Was today the first real crack in the AI multiple, or just a crowded trade donating blood to the rest of the market while the underlying AI and power theses kept gaining evidence?
We do not need to answer that in advance. We only need to know what would change the read: Capex guidance, yields, sector breadth, software behavior, AI financing, policy controls, and whether gold, utilities, uranium, and power equipment keep confirming the rotation. That's the updated wrap for Tuesday.